In lesson 6, we're going to talk about the financial statement and tax reporting consequences of the different cost methods that we choose. I have spoken about this in the other lessons, and we're just going to reiterate it here. In the first in, first out method, when we have rising cost, which is the norm, our ending inventory usually approximates the current cost. Well, it does approximate the current cost. In last in, first out, the cost of goods sold approximates current costs. So the current costs are either in ending inventory, first in, first out, or cost of goods sold, last in, first out. Weighted average smooths out those price changes, so it falls between the two. It smooths the price changes over all of the goods. In this example, we have the financial statements for trucking company, and you can see the specific identification method comes up with a net income of $713. And in that case, we specifically identified the costs to these goods that were sold. Under FIFO, we did first in, first out, and our net income was $721. Ending inventory was $1420. It's a higher ending inventory, higher net income. This is normally preferable for financial statement reporting. You're reporting higher assets, you're reporting higher net income. LIFO, last in, first out, with rising prices, reports a lower net income and a lower amount on the balance sheet. This is preferable for tax reporting, but not for financial statement reporting. The weighted average method, on the other hand, smooths out those costs and falls between the two, between the LIFO and the FIFO. And like I said earlier, the Internal Revenue Service requires that when we use LIFO for tax reporting, we must also use it for financial reporting. It is called the LIFO conformity rule. What we're going to do now in practice set number 6, our assignment, is we're going to walk through all of the cost methods in exercise 5.7 and talk about the effects. Hopefully you attempted this exercise on your own, and now we'll walk through it together. The first thing that we're going to do is use FIFO to calculate the ending inventory and cost of goods sold. Again, I'm going to ask you to look at the table in the textbook. I'm not going to be moving up and down between the table and the problem. On January 1st, we have units in beginning inventory of 200, and we're doing FIFO, so 200 units at a cost of $10 per unit. And our amount then is the 10 times 200. On the 10th of January, we had a sale of 150 units. So we're going to put that in here at a cost of 10 because we only have the one layer of inventory. On the 14th of March, we purchased 350 units for $15. And our ending inventory is, we forgot to do this over here, 200 minus the 150 is 50 units at 10. And we'll copy that down here too. And because I copied, now I've got to get rid of that line underneath because I don't want it there. So no border. And now I lost it here. You gotta be careful with your copy and paste when you've got the formatting in there. Now I'm going to bring over the 350 units at $15, and that equals 350 times 15. On the 15th of March, we had a sale of 300 units. So FIFO, I'm first going to take it from the 50 units at 10. And then I'm going to take the remaining 250, right, because we sold 300 total. I'm going to take the remaining 250 at 15. And what do I have left? I have none of the 50 unit at 10. I have 100 of the $15 layer. And on the 30th of July, we have a purchase of $450 for $20. And then our inventory is 100 at 15. And 450 at 20. For 9,000. On October 5th, we sell 430 units, so I'm going to take that all out of the, nope, sorry, we're doing FIFO, so I'm going to sell out of the 100 at 15. Oops, I'm off a line. Off a column, 100 at 15. And I'm selling a total of 430, so I'm going to sell 330 of the $20 equals 6,600. So none of the $15 remaining. Of the $20, I have 450 minus 330, 120 at 20. And then on the 26th, we purchase 100 at $25. So my ending inventory is the 120 from above at 20 and the 100 at 25. So under the FIFO method, I have sold 880 and my cost is $13,850. My inventory balance is $4,900. So this is what goes over to the balance sheet. This is what goes to my cost of goods sold. So over here, if I just brought in what are my sales? My sales are up here. I had 150, 450, 880 at $40, all the same sales price. So my sales are 35,200. My cost of goods sold is the 13,850. So my gross profit is the difference between those two. Sorry, I'm having some internet issues again. And that's going to be the 35,200 minus the 13,850 for 21,350. Just kind of wanted to do that so that when we're talking about this, you can see. So I'm reporting $4,900 on my balance sheet as ending inventory, right? I'm reporting 13,850 as cost of goods sold, and my gross profit here is 21,350. Let's move on to FIFO. Or LIFO, excuse me. So LIFO, we've got the same thing. We start on January 1. I'm just going to actually copy that down. We got 200. These three things will be the same because the first sale only has the beginning inventory. So that's the same under all the methods. Now when we get to the 14th of March, we've got 50 remaining at 10, and we'll have the 350 at 15. On the March 15th sale, we're selling 300. We're going to take that whole 300 out of the last batch of $15. And so what we have left, we still have the 50 at 10, and we have 350 minus 300 at 15. And then we go to the 30th of July. We have a purchase of 450 at 20. So now we're going to have all of this in our ending inventory. And then we're also going to have the 450 at $20. And the sale on October 5th, we sell 430. That's all going to come out of that last group because we had 450 there. And so then what do I have left in my inventory? I still have the 50. I still have all of that, right? I'm just going to copy all of this down. And we'll do a paste special. Whoops, I didn't get it copied evidently. Okay, so I have the 50 remaining at 10, and I have the 50 remaining at 15. And out of this $20 batch, I have 450 minus 430. I have 20 remaining there. On October 26th, we purchase another 100 at 25. And so now I'm going to bring all of this down again because all of those are still there. And then we're going to add to that the 100 at 25. And that equals 100, times the 25. And here I've copied down the sales. The sales number is the same regardless of the method. It's going to be the $40 times the 880 units sold. But my cost of goods sold here is going to be $14,600. So my gross profit is $20,600 compared to the $21,350 I had in the FIFO method. My inventory value is $4,150 compared to the $4,900 I had up there. My cost is higher, my inventory is lower under the LIFO method. Next, let's take a look at what happens in the weighted average method. Again, my beginning inventory is the same, so I'm going to bring that over. Actually, these two items are the same because we only have those goods to sell. So we're going to bring that down just like that. On the 14th of March, then we have a purchase for 350 units at a cost of 15, and we'll multiply that out. And over here, then we're going to do the average cost. So we have 50 units remaining plus the 350. My cost is the 500 plus the 5250. My average cost then is the 5750 divided by 400. On the 15th of March, we sell 300 units. So I take the 300, I grab that cost, and I multiply that out for a total of 43,1250. What do I have remaining? I have the 100 at the 1438. There's very little time, so I went ahead and completed this one. Again, we recalculate every time we have a purchase. We do a new average for the cost, and so then we sell at that average